The easiest option to invest in stocks is via index mutual funds. For example, Nifty 50 that gives you top 50 stocks in one single mutual fund. But the problem is if you're, let us say, investing 1 lakh rupees, 60% of that money gets invested in the top 10 stocks and the remaining 40 stocks hardly get any allocation. And if you do not want to risk putting your money into the top 10 stocks only, your good option is that you invest your money in equal weight index mutual fund. And in that case, what happens is your 1 lakh rupee gets equally divided into all top 50 stocks. So you will end up investing 2000 rupees in each of the stocks. Now, which one is better? So in this video, we are going to understand with some meaningful data whether you should look at investing in equal weight index or the normal index mutual fund. If you're new to my channel, please don't forget to hit the subscribe button and join me in becoming financially independent. With that, let's get this video started. So now what we are going to do is we are going to take specific examples of mutual funds or index mutual funds from both the categories, and we are going to see the battle of these two index mutual funds in terms of their performance. What you see on my screen is the first type of mutual fund, which is UTI Nifty 50 Index Fund. One of the best index mutual fund if you ever want to invest in a Nifty 50 market weighted index fund. I've created a separate video on this. Please go and watch it after this video. This mutual fund or this index fund, if we look at the asset allocation or the holdings, this is called market cap weighted index mutual fund. Simply meaning that your money that you will invest in this mutual fund will get allocated into the top 50 stocks in the proportion of their free float market capitalization. Simply put, if I show you Nifty 50 index, what you will see here is that in the Nifty 50 index, Reliance, for example, has got 10.50% weightage because Reliance has the highest free float market capitalization, and market capitalization is nothing but number of shares multiplied by price of one share. So Reliance right now is the heavyweight on Nifty 50 index, right? So if you go back to UTI Nifty 50, you will see that if you're putting 1 lakh rupees, for example, 10,000 rupees of that money will go into buying the Reliance stocks on your behalf, right? Now, interesting point to note about market cap weighted index mutual fund is that if you look at the top 5 stocks here, almost 40% of your money is going into top 5 stock. This is what I call very concentrated portfolio, okay? As a result of this, what happens is if you look at the sector allocation here, your money is getting allocated into fewer sectors. So if you see private banks here, almost 25% of your money is going into the private bank center. If tomorrow something wrong were to happen in the private bank sector, you are likely to be more exposed because you've put almost 25% money in private banks, right? So if you look at private banks here, look at HDFC, ICICI, HDFC, if you add this total, that itself come to 23 to 24% of the allocation, right? On the contrary, the second example we are going to take is the DSP Nifty 50 equal weight index fund. If you're looking to invest in equal weight index fund, it will say it in the title, right? And if it doesn't say in the title, you mean that it is a market cap weighted, which is the example we took in the case of UTI Nifty 50 index, right? So if you just come back to DSP Nifty 50 equal weight, what you will see here is that almost every stock is getting 2%, 2.2%, 2.9%, 2.18% allocation, right? So as a result, every stock is getting equal allocation. So your money, if you were to invest 1 lakh rupees, 2000 rupees is going to go towards ITC. It is not going to get Reliance 10,000 rupees in this example, right? As a result of this, what happens is if you look at the sector allocation, what is happening is almost all sectors will have more or less equal distribution. There will not be a big difference between the sector allocation. So here, for example, IT services is getting 10%, private banks is getting 10%. And what is happening is you are getting the benefit of diversification here, because if one sector were not to perform, what is going to happen is you are not going to have lower returns, right? Talking about returns, now let us compare these two mutual funds in terms of how they have performed over a number of years and which one has given better returns. So if we go to the UTI Nifty 50 index fund, if you look at the 5-year data, you will see that it has given 11.68% of CAGR in the last 5 years. If you look at the DSP and if we go to the returns of DSP, what we are going to see is for 5 years, DSP has given 10.24%. So when it comes to 5-year period, what we are likely to see here is that the equal weight index fund has given less returns. Let us now compare 3 years data. So if you go to 3 years, Here DSP has given 29.06%. What about UTI? If we have a look at UTI, we are likely to see that UTI has given far less return when it comes to 3 years, 24.25%. Now there's a very interesting concept and insight that I want to share with you is that there is a reason when equal weight index fund performs far better than the normal index fund, right? And that is called during the bull period, bull run, right? So if you look at the last 3 years, what you're seeing is the stock market here skyrocketed like anything, right? You see 3 years, it's gone like crazy, okay? If you look at the Nifty chart, what you will see is that in the last few years, if you look at from, let us say, if you look at from 2012 onwards, the growth of the market has not been that high. It's been almost flat or slightly picking it up towards the 2017-18 period. But if you look at after COVID 2020, there is a sharp increase in the stock market returns, right? So this I can call it as a bull run because it has given me more than 20% appreciation in the stock price, right? So during the bull run, which is what has precisely happened in the last 3 years, equal weight index fund tend to perform better. Now you will say, Rahul, where is the data to prove it? I am going to share with you something very interesting that is there in the Value Research as a very good article to read. I'll link it in the description as well. Here you see 5-year performance. If you look at the totally 5-year performance, what we are going to see is that whenever stock market has given more than 20% returns, please know that this is a typo here. This is greater than 20%. So they've got 3 buckets here. When the stock market gives you less than 10%, if it gives you between 10 to 20, or when it gives you greater than 20, what happens? So in the last 5 years, whenever, so if you look at the last 5-year performance, whenever stock market has given greater than 20% return in a particular year, equal weighted index fund has 100% times beaten the market cap weighted index, right? If we go down to 7-year performance, exactly the same result, that in the last 7 years, if you look at any year, what we are going to see is that equal weighted index has beaten market cap index whenever the stock market has given us more than 20% returns. Again, look at the 10-year performance, exactly the same result, that if the stock market has given more than 20%, then equal weighted index has performed far better than market cap weighted index fund, right? So from a returns perspective, it depends on the market conditions. So if you think that there is going to be a bull run in the next 3 years, where are you going to invest your money? In the equal weight. But if you think the market is going to be more or less flat, or it is not going to grow at a very high speed, then you're better off with the market cap weighted index fund. Also, I want to compare and show you the SIP returns. It's very important. Few of the investors, they use the SIP route. If you look at the SIP returns in the last 3 years, you will see that from a SIP perspective, DSP has given better returns than UTI. And from a 5-year SIP perspective, again, DSP has given better returns than UTI. So from a SIP return perspective, if you look at the SIP return here as well in the ticker tape, you are going to see 40% here from a DSP perspective. And if you look at the SIP perspective UTI, you are going to see 35%. So from a SIP perspective as well, equal weight has given better returns. But our conclusion here is that where should you invest? That is where the question is, right? You or me or nobody can predict the market conditions or how the market is going to react in the next few years. Therefore, please do not try to time the market. The sensible investment strategy here is that you allocate equally into equal weight as well as into the normal Nifty 50 index fund. Do not just invest your money into one index mutual fund. Go for a 50-50 allocation or 60-40 allocation, depending on your appetite to take risk, rather than investing all of your money in one single index mutual fund. I hope you found this video useful, and if you did, please let me know by comments. It will motivate me to continue making good videos for you. And if you have not yet subscribed to my YouTube channel, please do so. I will see you in my upcoming videos. Keep rocking.